You so much for joining with us. And in this segment, I want to talk about the roller coaster versus the merry-go-round of investing and what we're doing and what's going around the world and the crazy game that's being played out there. So when you think about this, one of the things I want to make sure that you understand over the long term is the 5 steps to financial freedom. Now, it's a game. Money is a game. Success is a game. We're not curing cancer, okay? We are simply playing a game. And if you play the game and do well, you get bonus items, you get perks. Money is a game, success is a game, and games are fun. We want to have fun. And the way you have fun in a game is you change the rules, okay? So when I go golfing, I'm not a very good golfer. I've had 2 back surgeries, and so it's kind of a challenge for me to go golfing. I changed all my rules. So instead of being upset if I didn't score a certain number in golfing, I changed my rule that I only want, if I get 1 good hit the whole day, I'm happy. Going to football games, half the crowd is upset. Half the crowd is mad if their team doesn't do well. I changed the rules. What are the rules? If I see a good play and I don't care which team did it, I'm happy. All right. You got to change the rules. What makes a game fun is to change the rules so that it's easy to win and that you can have fun playing it. Money is a game, success is a game, and games are fun. So let's have some fun with it. Now, the 5 steps are very simple. And the reason I keep going back to the 5 steps is we have a lot of new students that keep joining us from around the world. And I want to reiterate the complexity that everybody that you listen to, everybody gets confused because of all the moving parts. The reality is that the most successful companies are the companies that have figured out how to simplify it and then multiply it, okay? We call nail it and scale it. Get it down as simple as you can and then multiply it as quick as you can. The more confusing it is, the harder it is to make it work, okay? So there's 5 steps to making money. Step number 1 is that you need to make more money. The way you make more money is by solving problems and adding value. If you add more value than other people, then you will make more money. And if you do this at your job, if you add more value, most people say, I want to go to work and I want to do the least amount that I can to make the most money. Well, that's just the wrong attitude. It's a game. You're playing against other people in that business. And your goal is to do the most you can to add the most value. Because when marketplaces get tough and layoffs come around, the first thing as an employer, and I've had some very big businesses, the first thing that employers do is they look and they say, okay, well, the business isn't as big as, we're not doing as much sales, we don't need quite as many people. Who are the most valuable people we have? And they put those people over in this category. And then we look at the people that are not as valuable, that are not making as big a contribution to what we're doing. And those are the first people that get laid off. And you can see that there's new layoffs going around all over the world. Now, remember, the economy, it's just a game. Money is just a game. And as you watch it, you can see which games people are playing all around the world. But step number 1 is you need to make more money. You need to add more value. You need to solve bigger problems. You need to study successful people. When you study successful people and do what they do, you can be successful as well. Now, when you're doing this as a job, if your employer doesn't value you, then there's somebody else will. Okay? So your job is not to be the least amount. Your job is to be the most amount. You want to, because as a business owner, and I've owned some very big businesses, and I've had thousands and thousands of employees, it's very stressful for the people who are in top management because they feel like they have so many families and lives that they're responsible for. I felt that in my businesses. And it crushed me. The economy turned around when we did the first war with Iraq. Our whole businesses just got crushed, and there was nothing I could do about it. So your goal is to be valuable. Number 2 is you need to separate and sort your money. You need to create systems. Now, the reason I say that is because if you create some systems to run your own household, what happens when you start a small business? you're going to have to figure out how to manage that. There's got to be a little system to be able to manage that. When you start buying real estate and rentals and all of these different things and investments, there's systems. And all we do is add zeros. So I look at the millions and millions and millions of dollars that I've done, hundreds and hundreds of millions of dollars in businesses. We created systems. McDonald's is a system. The McDonald's brothers created a wonderful store. They created a system, but they didn't have a system to duplicate it. That's where Ray Kroc came in, and he duplicated it. Okay. Walt Disney was a genius. He was very creative, but it was Walt's brother Roy who created the system. He created the system so that all these things continue to work. So you've got to work on your systems, but the big piece is you need to sort your money. Number 3, you got to give some of it away. That's what we're doing with our Make a Difference programs. Number 4 is to automatically invest. Now you're probably saying, I don't want to invest right now because of all the craziness in the world. That's correct. But as you're looking a year from now, or 2 years from now, or 10 years from now, or 20 years from now, we're all going to be on this earth, God willing, and we're all going to have to deal with money. So that's all part of the game. So the next, number 4, is to automatically invest. And number 5 is to save and spend. Now, why is automatically invest in its own space? Well, because that is crucial. If you do this one thing and you do it consistently over your lifetime, it's going to solve the majority of your problems in your lifetime, is the auto investing. And so that's why it's important. Now, what is auto investing? Auto investing is anytime that you make money, we want you to put it down here into the wealth formula. The wealth formula is putting money away times time. You need to do that over a period of time. Not a week, not a month. You need to do it over years. The really successful people do this. They plant money trees that grow, and they take care of those money trees. So you do that over time. Times have a go up in value. Have a go up in value. Now, when we talk about go up in value, there's 2 things. There's appreciation and inflation. Okay, there's 2 things. Now, the difference is that if things go up in value, and I own a lot of real estate, and I'm going to a conference today with Jake, and in that room, I'm just a little guy. There will be billions of dollars of net worth in that room. As a total group, there'll be billions of dollars of net worth in that room. And all they did was add zeros, and they created generational wealth that they passed down from generation to generation. But the wealth formula is you need to put money away every time you make it, times have a go up in value. So inflation is all these governments around the world that can't pay their bills. They can't pay their bills because they're spending too much. Now, there's many countries around the world. Norway is one that I've really kind of followed that doesn't have that kind of debt. Okay. But there are different countries that borrow all kinds of money to finance all kinds of things that is kind of a challenge. But when they do, they literally just print more money. They borrow more money. It's like you having a credit card and there's $1,000 limit on it. And then you need more money. So the bank just increases your limit to $2,000 or $5,000. Well, it's not solving the problem. You still have all that debt, but it's making the problem bigger. Okay. And it gets bigger when we have to increase interest rates because of inflation is going so fast and so hard that it's really hurting people. Now, who's it really hurting? It's really hurting the people that do not have assets. So you need income producing assets, real estate, rentals, businesses, stocks, and things like that. And again, I'm not looking at this week or this month. I'm looking 10 years from now. Warren Buffett is, I'm a big fan of Warren Buffett's, and that's the kind of stuff that we're teaching. But appreciation, as real estate gets more expensive, somebody owns it and somebody is renting it. Okay. So when real estate is more expensive, it appreciates in value. That's good if you own it. It's terrible if you're renting because now your rent's going up. So I appreciate it when appreciation happens. It's the same thing as inflation. It's just that I own it and somebody else doesn't. So so that's why that's so important. And you have to have income producing assets. A car is an asset. and it can help you make more money. A college degree is an asset only if it makes you more money. Okay, only if it makes you more money. A business is an asset if it makes you more money. Is it an income producing asset? A farm is an income producing asset. Rental real estate is income producing assets. Now, there's other assets that go up in value like gold, Bitcoin, and things like that, but they don't produce income. Okay, so that is an asset that goes up in value or down in value. But the real key is to find assets that go up in value because they make money. That's the key. Now, most of you need a side hustle. Most of you need multiple streams of income. You need to make more money because of inflation. It's getting harder and harder for you to make it because the governments around the world are printing so much money that it's very difficult to do that. So you need a side hustle. You need to start flipping some things. You need to flip some products. You need to be able to buy it and sell it and be able to make some money with it. You need a small business. You need all these different ways that you can bring in more revenue. And then as you make a profit, we want you to put it down here into the wealth formula. But the big thing I want to talk about right now is I want to talk about investing versus trading. Because one of the things that we're really pushing you to do is to have a number of things. Number one is a small business. All of you need a small business. You need a small business for a couple of purposes. One is to make more money, but number two is to provide some tax benefits. Around the world, people that make money get taxed. And so one of the things we want a small business because it makes us more money and it gives us some tax benefits. That's why you need a small business. So all of you need a small business to be able to help you make the math come in to what we're doing. Now, on our investments, we talk about getting an investment account. The reason is because we want to change the way you think. The simplest, fastest, quickest way to be able to do that is to get an investment account. Now, we are not traders. We are not buying and selling and trading. We're investors. It's the opposite. We're Warren Buffett. We follow Warren Buffett. Now, there are a few people and very few that can day trade, but we don't. I've lost a fortune day trading, and I backed some people that did that. But it was a small percentage. It was a smaller percentage of our whole net worth, and so it was something that we did. So there's a couple of things I really want to teach you and sort of remind you. Number one is that you're either going to loan or own things. You're going to either loan or own. So as you get money into your world, you're either going to loan it out to someone or you're going to own something. Now, if you have money in the bank right now, if you have money just on your phone, you are loaning money to the bank right now. If you got 1,000 pesos or $1,000, you're loaning money to the bank because guess what the bank does? The bank is taking your money and loaning it out to someone else. Now, I'm going to go off on a tangent for a second. It's even crazier than that. It's called fractional banking. And so for every dollar or every peso that you have in that bank account, the governments allow the bank to loan out 5 to 10 times that amount. It's called fractional banking. And it's just crazy because you think that you put that little bit of money into the account, you're loaning it to the bank. You are loaning it to the bank and the bank's not paying you anything. And then they're not only taking that money, but they get to multiply it by as much as 10, and they can go out and loan 10 times as much out into the marketplace. That's called fractional banking. And that's one of the things that's been getting so many countries in trouble because it's part of the leverage. But you're loaning money. Now, if you loan money to the bank, they're not paying you anything. And what are they doing with it? They're loaning it out to somebody else. They're taking it from you at 1% and they're loaning it to somebody else at 4 or 5%. And they're making that 2 to 3% spread. Okay. And they make a fortune doing that. Today, we're going to be in one of the tallest buildings in Salt Lake, the Wells Fargo building. And there's a story about one of the managers that was there, that was in this big old building looking out over all of this beautiful city of Salt Lake and thinking all these people are putting money into our bank and we're taking their money, we're paying them a little bit of money and we're loaning it out to someone else and we're making the difference. And we're making the spread on that. So all of you are loaning. You're loaning money even if you didn't think you were. Now, if you're loaning it, we need to find a better way to be able to make more money when you loan it out. So one of the ways is just in your checking account. One of those ways is a long-term bond or a CD. Okay. And so that's part of it. Now, many people are a little bit concerned about what's going on in the marketplace. And so they don't really want to be in the marketplace right now. The marketplace, the stock market and all of that goes because of supply and demand. All right. It's all supply and demand. So you're either going to loan money to somebody, even if you just put it into your checking account, you're loaning money to the bank and they're not paying you anything. And they make you feel stupid when you walk in the bank. You're loaning money to the bank, or you're going to own things. You're going to own things. You're going to own stock. You're going to own real estate. You're going to own different investments. So you're either going to loan or own. That's really crucial to be able to do that. Now, one of the things that you can own that's very simple for most people to do to start with is with stocks. But I want to teach you another little piece right here. There's two more pieces. One is that I want to talk about is asset allocation. Now, what is asset allocation? Asset allocation is when you are taking money and you're splitting it up between different things. For example, you can loan money. I'm just going to come down here and we're going to do asset allocation here. Loan. Well, who can you loan money to? You can loan it to the bank. You can loan it to a country. You can loan it to a corporation. You can loan it to a school district to build schools. This is a loan, or what we call a bond. In a bank, it's basically a checking account. If you're loaning money to a country or to a corporation or to school, those are what we call bonds. Okay. Now you can own. What can you own? Well, you can own stock. You can own real estate. You can own businesses. You can own all kinds of things. Now, asset allocation is what percentage of your net worth do you have in these different areas? So if you have 100 of something, because that will be real easy to be able to look at, it's going to say, well, how much of that do you have in your loan versus your own? Now, if you're older, you probably have more bonds. If you're younger, you'll probably have more stock. But the big thing that I want to teach you, that I want you to make sure that you understand, is the asset allocation of what we do. Not only into stocks, but we have different kinds of stocks. And we're going to talk about that in a second. But for most of you, you should be simply an investor. And we invest in the 500 biggest companies in America because they're global. They're all over the world. We invest in Berkshire Hathaway stock. I'm a big Buffett fan. Now, I'm not telling you what to do. I'm just telling you what we do. And the foundation has $3 million that we donated in real estate and in stock, Berkshire Hathaway stock and Facebook stock. And as it makes money, we give that money away. So that's kind of the crucial piece of how we do it. But inside each of these, there are subgroups. Okay. So you might have 50% of it here and 50% of it here. And of that 50%, you might have 25% in stock and 10% in real estate and 10% in business or whatever it is. The key is I want you to understand the concept of asset allocation. You're going to spread your money in different places. Now, some of you are just doing a business and you're putting all your money back into your business. You're doing your side hustle. And as you make money, you're putting it all back. You're putting it all back. You're putting it all back and rolling it, rolling and rolling it. And there's nothing wrong with that. But I want you to understand the concept of asset allocation. Now, the last concept I really want to teach you about is about supply and demand. And, people say, well, why is the stock market going up? Or why is the stock market going down? Why is real estate going up? Why is it going down? Well, it's called supply and demand. Now, what happens with supply and demand? It's a law, and it's very, very simple. If I have 3 of these markers that I'm trying to sell, and I have 3 markers, and I have 10 people that want to buy them, 10 people want to buy them, guess what happens to the price? It's going to go up, isn't it? Because all these people are competing for these markers. So if I have 3 markers and 10 buyers, it's going to go crazy, isn't it? Now, if I have 3 markers and only 1 buyer, only one guy that's interested in buying it, then these guys are going to get into kind of a tug of war and the price goes down. So the supply and demand, 3 markers and 10 buyers, well, price is going to go up because the 10 people are trying to buy it. But if I've got more markers, I got 3 markers and only 1 buyer, then the price goes down. So I want you to understand the concept of supply and demand. So supply and demand, what are the things that people are chasing? Well, real estate is one of them. Stock is one of them. And bonds are kind of a big one right there. Bonds and cash. Now, what happens in the marketplace is that things move. People vote with their wallet. They move money different places. So if there's a whole bunch of money in stock and the interest rates are really, really low, which they have been for quite a while, if the interest rates are really, really low, then where's the money going? Well, people want to own companies and they want to own real estate because the interest rate has been artificially low. It's been too low for too long. Now, when that happens that's when inflation starts to come in. So as a result, these are attractive. So all the money rushes there. That's where the money is going. Now, over the last just last little while, they've been increasing the interest rates around the world because the market's running too fast. There's too much inflation. And so now these are more attractive. Instead of being a 1% or a 3% that you could borrow money at, now it's 5% or 6%. As a result, people are taking their money and saying, hey, I don't really want it. If I can get a 6% return, I would rather put my money down in bonds. And so it's leaving this area and going to this area. It's leaving stock and it's coming over here. So that's why it's so important that you can see where money is going. Now, part of that also is that the governments around the world do things. They say people are smart, but groups are dumb. And you have all these things that affected. COVID has this massive ripple effect that is still going through the marketplaces and the supply chains. The big thing is that we're not looking at what's going on this year. I'm looking at stuff that's going to happen in 5 years or 10 years from now. Warren Buffett loves it when the stock market goes down because he likes to buy stuff when it's cheaper. So that brings me to another principle that I want to talk to you about. And that principle is called dollar cost averaging. Now, before we do that, again, you're either going to take your money you have and you're going to loan it. You're going to just leave it in the bank, which is okay. Asset allocation says, hey, I just want to leave it in the bank, and you can do that. So you can do that, or you can put it down into stocks or something else. But if you are going to invest in stocks, this is what I recommend. There's only 4 ways that you can really invest in stocks. Number 1 is you can pick and choose. You can pick and choose the different stocks that you want, and it's kind of fun. You can have fun doing it. Number 2 is what we call a mutual fund. Okay. Number three is an index. An index, which happens to be the 500 biggest companies in America. The S&P 500 is an index. It's just a group of stocks. And the last one that I really like is number 4, which is Berkshire Hathaway, BRK, which is a stock. It's Warren Buffett's company. Now, let me talk to you about why these are important. Because traders, people that have a little bit of money and they're trying to buy it when it goes up, they're trying to sell it when it goes down, and they're playing that odds. They're trying to beat the system. And the problem with that is it takes all your time and all your energy. If you're doing that, you probably don't have time to go make more money. You don't have time to build your side hustle because you're spending all of your time trying to take whatever you have and do a bunch of pick and choose. Now, I'm going to buy, I'm going to sell, I'm going to buy, I'm going to sell, I'm going to buy and sell. The vast majority of people do not make money. Just like going to Las Vegas, the vast majority of people do not make money when they go to Vegas. They have fun, but they lose money because the odds are you're going to lose. For every winner, there's a loser. For every person that buys, if somebody's going to win, somebody's going to lose, and everybody's going to pay a commission. Now, with that being said, one of the things that this is a trader, I'm trading, and you can take a little bit of your asset allocation and put it there. So as you look at all your stock, you say, okay, I've got some in loan, I've got some in own. In my own, I have some real estate, I have some small businesses, and in my stock portfolio, then I'm going to kind of split that up between these four areas. So the first one is picking and choosing. The second one is a mutual fund. And a mutual fund is where you hire a professional to manage your money. And so all these people around the world pull their money together and they hire professional people to manage it. Now, the only problem with that is that they're going to charge you between 1 and 2%, which we call money under management. So for every 100 pesos or dollars or yuan you put in there, on a year-by-year basis, they're going to charge you 1% to 2%. Now, most of the time, you're never going to see those charges because they just sneak it. They just take the money out of your account. You'll never see it. So you've got to dig in and say, what are the costs to do that? And this is a professionally managed fund that you're hiring people to do that. Number 3 is an index. An index is just the 500 biggest companies in America. They call it the S&P 500. And the symbol for that is SPY. SPY. And what that is, that's the 500 biggest companies in America that are global. Now, you can do other indexes. You can do an index of just about anything. You can do the Dow, which is the 30 different industries. You hear about the Dow 30, which is a crazy thing to listen to because that's only got 30 companies in it. There's a computer company, there is a car company, there is a software company, there's a grocery store. It's one thing from each of these different industries. So that is what the Dow is, and people watch the Dow. I don't really care about the Dow. I want to talk about the 500 biggest companies and how well they do. And the last one that I really like is Berkshire Hathaway. Now, what's Berkshire Hathaway? Berkshire Hathaway is like an index fund. It's a big index fund. The difference is that it's a stock. It's a stock that you can buy, and so the cost is really low to buy. And this is a company that Warren Buffett started many, many years ago. Warren Buffett and my dad is 4 days older than Warren Buffett. And I had the privilege of having a dad that was similar to Warren Buffett. Now, Warren Buffett added a lot more zeros than my dad did, but it would be similar to talking to both of them about what they believe and their common sense to everything. So Berkshire Hathaway is a stock. And you can invest in Berkshire Hathaway, which is a big part of what the foundation is. And again, I'm not telling you what to do. I'm just trying to educate you on some of the things that we do. But Berkshire Hathaway is similar to the S&P 500, except for it has more of something. Okay, it has a lot more of something. For example, 40% of Berkshire Hathaway's holdings is in Apple computers, iPhones, things like that. So a big proportion of their total assets are in Apple and other companies that Warren Buffett and his group, and he's got a massive group and all kinds of managers. They own all kinds of businesses, and it's a big insurance company. So they make, and they do really well. So it's very stable. Now, over time, the cost is a lot less over here. To invest in over here, the cost is going to be very, very low. It's going to be a lot smaller than this one. This one is going to be basically, it's going to be almost zero to nothing because it's a stock. You can buy all kinds of stock for a small amount. Now, over time, this one and this one perform better than each other. Over a long period of time, this one has outperformed this one over a long period of time. Not 1 year, but 4 years, 5 years, 10 years. This one has outperformed this one, but on a yearly basis, they kind of swap, but that's probably the biggest one. Now, those are the best two that make more money than that one. Why? Because of the fees. And they make more money than that one. So as you're getting started, you are an investor. What do we invest in? We invest in that and we invest in that. Now, if you like to have some fun, well, if you have 100 of something and part of your asset allocation is stock, We'll take 10% of it right here. We'll go ahead and take 10% and pick and choose. There's nothing wrong with you picking and choosing. I love studying companies. I bought 10, 15, probably $15 million worth of stock that I've traded over the last little while. Okay. So I've done a lot of that. I'm not very good at it. In fact, I've lost my shirt on it because there's a couple of companies that just went the other direction that I had no idea was going to happen. And we just lost our shirt on it. Take a little bit of it and put it here, and then take the rest of it and put it over here. Now, when you are smarter than Warren Buffett and you're smarter than the 500 biggest companies in America, then take more of this and start doing more of it. But the problem is what people do and how they get into trouble is they hear a stock tip, and I'm guilty as charged. They hear a stock tip and then they take all their money and they go gamble it, like going to Vegas and gambling it on the roulette wheel. And they think that they're going to make a lot of money and they just lose it. They're traders. We are not traders. We're investors. We're long-term investors. Okay. So that's the kind of the thing that I wanted to talk about today. Now, the roller coaster, the stock market and real estate and investing is a roller coaster. Goes up, goes down, goes up, goes down. But what's happening is that they call it 2 steps forward, 1 step back. 2 steps forward, 1 step back. 2 steps forward, 1 step back. And what's happening around the world again is inflation. These governments can't pay their bills. So what do? They just print more money. They make bigger problems out of all of it. There are some countries around the world that don't have that. Norway is one of them that I've studied that doesn't have that kind of debt. But it's a very different kind of a country because it has a lot of resources, oil, great technology, and a small population base. Saudi Arabia, Dubai, things like this have a massive amount of supply of something like oil and a very small population base. So the average person lives better. People in India, people in China, on average, don't live as well because they have resources, but they have a lot more people for those resources. Anyway, so that's the key right there. As we talk about the marketplace, remember, it's just a game. If you want to sit on the sideline, sit on the sideline. You've got loan and own. And if you just want to sit on the sideline and leave it in the bank for a while, you can do that too, because we're in a down cycle because the interest rates have gone up and people are saying, hey, I want to get out of the stock market and just put it into bonds because that's safe. I don't want to do that. That's safe. I want to get out of my real estate and I want to put it into bonds because it's safe and it's a halfway decent rate of return. So money is leaving these other investments and going after something that's more safe, which is more of the loan side of it. Okay. So there's nothing wrong with sitting on the sideline. Now, for you that already have stock, it's just a game. You haven't lost money until you sell it. Okay. You haven't lost money until you sell it. And for a lot of you, you're seeing you bought some stock and now it's gone down. You still have the same number of shares. You still own the same number of shares. Now, again, I'm not telling you what to do with your money. I'm just telling you some of the stuff that I do, and I'm just going to wait it out because eventually that will turn and go the other direction. Every market goes up and every market goes down. And it's cyclical. And sometimes that cyclical is getting longer. So just be aware of that. And again, if you want to sit on the sideline, we'll just put it in the bank. If you want to do some bonds, do it there. Eventually, you're going to see that it's going to start hitting bottom where the supply and demand is starting to change. Everything, the stock is the value's less. Warren Buffett doesn't like it when the stock market's high. He likes to buy stuff at a discount because he knows what he's looking at is stuff down in the future. Anyway, this has been Tom Painter. Thank you guys so much for being in our class today. Go out and share the wealth. Share the wealth. All of you have a QR code that's when you go to successandmoneyfoundation.org, get a free membership. We're a foundation. We're a nonprofit. We are a charity or an NGO. And our goal is to be able to teach these great concepts. And we're not telling you what to do with your money. We're just telling you some of the things that we do. So go out, make a difference, make it happen, and remember that every life is precious. Thanks for watching, everybody. And we're going to come back and talk to our people that are live And as you know, we do these live classes on a weekly basis.